Thank you for joining us at this Magellan briefing, and as many of you may know, the Global Fund has recently achieved its third anniversary, and we're in fact delighted that over that period we've been able to preserve people's capital over a very challenging investment climate, and more importantly been able to achieve a performance of over 30% outperformance since inception of the fund. In fact, we've got Hamish Douglass, our portfolio manager, here to comment specifically. Hamish, over that period you've navigated some fairly challenging economic and investment market environment. Can you comment on what's going on in the portfolio?
Well, the last 3 years has been a very challenging period, and what we've been very concerned about is not a recession and not about what's going on in China, although they're interesting backdrops in inflation and deflation. What we've been concerned about is the possibility of a systemic financial system collapse, because if you get a financial system collapse, you're virtually back to the 1930s of the Great Depression. And there's really been three big events over the last 3 years that has taken us to the brink of a collapse. The first was when Bear Stearns collapsed and then was rescued back on the 16th of March 2008. And at that time, what we were very concerned about, and what we'd written about in 2007, was the importance of these very large investment banks and hedge funds and how they could have a domino effect on the world's financial system. And when Bear Stearns was rescued and bailed out by the Fed and JP Morgan, we were a lot more relaxed that the regulators actually had it in hand and understood the risks that those institutions and their importance in markets. But 6 months later we had the collapse of Lehman Brothers, which was actually on the 15th of September 2008. And when that occurred, 3 days later we had the collapse and then bailout of AIG, and on that day the Reserve Primary Fund, which is now very well known, effectively broke the buck when it held some Lehman Brothers debt. That was a money market fund in the US, and literally that took the world's financial system right to the edge of collapse. And regulators and governments around the world had to invoke policies that have never been seen before to effectively stop the world's financial system and the world's banking system from totally collapsing. And believe it or not, we've actually seen the third time where the world's financial system has been tested, and that was actually in April and early May this year with the sovereign debt crisis in Europe, which we've spoken about many times with our investors, coming out of Greece and then rapidly could have moved into other states, which could have put enormous strains on the European banking system that is still in a very fragile state. So really what we've been concerned about is a full-scale collapse of the world's financial system, and particularly the banking system over that period, and that's what we've been focused in, trying to protect people's capital.
And so Hamish, over that period, what are some of the more significant tactical changes you've made within that portfolio?
Well, tactically, obviously, when we're thinking about a financial collapse, it's our financial exposures in the portfolio and companies which are exposed to the funding market. So obviously banks is an obvious place to look at, and what we have done over the time is we have dramatically increased our cash weighting from time to time. Prior to the collapse of Bear Stearns, we ran a very high cash balance, over 30%. When they bailed it out, we actually ran the cash balance back down. But then when Lehman Brothers collapsed, we ran the cash balance back over 30% and dramatically reduced our exposure to financials. And then in April again this year, when we're running about 2% cash, we went back up to about 12% cash, reducing our financials exposure again. We've also been looking where we've had our currency exposures in this market. So it's really our financials weighting, our companies that are more exposed to funding, not that we have a lot of exposures to funding outside the banks we own, and how much cash we've held in the portfolio against that sort of systemic financial system collapse. It's not trying to predict a recession or something of that nature. It's something far more severe we've been very watchful for.
And what hasn't changed over the last 3 years?
Well, what hasn't changed, Frank, is really our investment philosophy hasn't changed at all. Where our objectives are to preserve people's capital and to get people a very satisfactory return over time. We haven't quite got the return. These markets have been very challenging. We're in positive territory over the last 3 years. We've preserved people's capital, and we're very much focused on investing in the highest quality businesses in the world with huge long-term competitive advantages, and we're seeking to buy a relatively concentrated portfolios of about 25 companies on a value basis that we think are going to get us above 9% returns compounded over time. And our philosophy hasn't changed at all, and the style of companies we hold haven't changed at all. And many of the names that you would have found in 2007 are still the same names you find in the portfolio today. Believe it or not, we're feeling incredibly comfortable about the portfolio, notwithstanding you've still got a lot of macroeconomic noise out there in the world and people are nervous about double-dip recessions. We actually think the risk of a systemic financial system collapse has actually receded dramatically. Now the European regulators appear to be getting on top of the sovereign debt and banking issues in the European markets, and we really feel the US is very much on top of those issues in the United States. So really you're talking about just macroeconomics, sort of a recessionary environment, growth environment, and we're really feeling very, very comfortable about the portfolio at this point in time. We're still very weighted to big multinational consumer franchises, businesses like Yum Brands and Coca-Cola and Nestle and Procter & Gamble and Colgate that have between 25 and 50% of their profitability coming out of the big emerging markets in the world. And we feel very comfortable where these companies are priced at the moment, of achieving very satisfactory returns with very low levels of risk for people over the next 5 and 10 years. We also have in the portfolio exposures to the financial system in the highest quality banks in the world. Wells Fargo is a large position, as is US Bancorp, and we've got an exposure to the payments industry through our holding in eBay, through our holding now in Visa and MasterCard that we've recently bought into during this uncertainty with the sovereign debt crisis in Europe, plus some uncertainty about the regulatory regime in the United States. And we've always held American Express, and we're very, very comfortable with the overall shape of the portfolio at the moment, and we think it's going to do pretty well in an environment that we think is going to be tough macroeconomically moving forward, but we are much more comfortable about the stability of the financial system, which has been the major risk over the last 3 years that you've had to be able to navigate.
Hamish, you've spoken to lots of advisors over the last 3 years. What's some of the feedback that you've received from advisors?
Well, what we're hearing about the Global Fund from the financial advisor community is really its simplicity in terms of the types of businesses it invests in and its understandability. We're into almost household name companies that advisors and their clients can understand, and also they've been saying that they understand the relevance of our portfolio for an Australian or New Zealand client, where we're effectively a large part of the Australian market. We're not in any energy or resources companies, and we're unhedged to the Australian dollar. So we're actually giving investors, in a very simple and transparent way, household name companies that are exposures you simply can't buy in the Australian market, like the payments space or multinational consumer exposure to the emerging markets, that complements very well with an Australian portfolio. So we're actually having a lot of very positive feedback from the advisor community about the fit in an investor's portfolio.
Thanks, Hamish.
Thank you, Frank.